precious metals for more than just inflation. Featuring Monex and the world-renowned commodities research firm, the CPM Group, led by Jeffrey M. Christian.
Hello, my name is Sean Brazney, Sales Director for Monex Deposit Company. I have the pleasure of being here today with Jeffrey Christian, Managing Partner and Founder of CPM Group, and one of the many analysts over there at CPM Group. Again, thank you so much for being with us today, Jeffrey.
It's always my pleasure.
When we're looking at gold, of course, we're here to talk about our precious metals for more than just inflation report. And focusing on gold because in September, October, and November, we saw gold hit some low prices that we haven't seen in about 2.5 years. September and October tapped at 1621 lows for each month. And then November here just recently came down and tapped a 1618 low. And when you're out there online and reading some of the information, come across some information that talks about central bank buying of gold. And you and I always talk about central banks being very price sensitive and seeing the lows when they want to be buying gold. But can you share some more data with us on what we're seeing out there as far as central bank buying?
Sure. We've actually seen stronger central bank buying for a couple years now. And last year, 2021, central banks bought about 11.8 million ounces on a net basis as a group of buyers. It's down on a net basis this year, but what we've seen is exactly what you were talking about. With the lower gold prices in the second and third quarters, we've seen a lot of central banks buying gold. And they're taking advantage of the fact that the prices have come down. So in the second quarter, you saw about 3.3 million ounces of net central bank gold purchases, and they came from a number of different banks. And in the third quarter, the reported amounts of gold that central banks have bought has been around 2.3 million ounces.
Great information. Coming along with gold, though, kind of a sub-question is in November when gold was tapping at 1618, and I have the pleasure of talking to investors or traders who are thinking about buying gold, and I continued to hear 1,500, 1,400, and waiting for the price to go down. And I was talking about the potential to come back up into this 1688, 1720s area for gold. And in the last 5 days, we've seen it move over $100 an ounce. And today, intraday high at 1720. I don't know if this is a question for me that I want you to answer or for my investors to maybe help with my own psychological well-being. But when you see it rally like this, you see investors that tend to buy after it goes up. They don't look for that low to purchase. Can you share some wisdom with us that helps our investors to maybe avoid that psychological mistake in the future?
Yeah, I think there are two things that work with investor psychology. Excuse me. One of them is actually rational, which is a lot of investors don't want to buck a trend, and they are, quote, willing to give up the first 10% of a move. So, you've seen gold prices falling, and people keep saying, well, this has got to be the base. This has got to be the base. And then it goes to a lower price. This has got to be the base. And then, as you said, there were any number of people who were capitulating, gold bulls who were capitulating and saying, oh, forget it, this thing's going to $1,500. There's no basis that we could see for that kind of projections. But, there are any number of investors who rationally say, I'm not going to stand in front of a runaway train. I'm going to wait till the prices stabilize and start rising. And I'm willing to give up the first 10% of an upward move before getting back in. So I think that that's one of the things. The other thing is that is the bad aspect of the same psychology, which is investors who say, I'll only buy into a rising market. And fabricators, jewelers, and electronics companies, when the price rises, they buy less gold and use less gold. But investors, when the price rises, there are any number of investors who race into a rising market and won't buy in a lower market. And you've seen this. I mean, it's been very frustrating my entire career. in the late 1990s when copper was like 60, 70 cents a pound, we were telling our clients, buy as much copper as you dare, and no one would buy it. And then when the price got to $1.40, $1.80, they started buying it. So there's this bad aspect, which is investors chase prices higher and lower. But then there's also a good aspect, which is, don't jump in front of a runaway train. Wait for the price to stabilize. And when you start seeing it rise, that's when you buy. And I think that you're seeing a combination of those factors today and over the last several days.
And between the two, they tend to even out. And I know I've been wrong in the past, and I'll be wrong again in the future. That's the sanity that I try to hold on to. Getting back to the dollar. September, October, and November, the dollar was trading up at some highs that we haven't seen since 2002. 20-year highs in the dollar. A lot of speculation out there as to why the dollar might be up at that kind of a level. But in November, it flashed what could be a potential, at least short-term technical top. And I'm wondering if maybe this week's Thursday CPI number is something that might put a floor under the dollar and have it surge again? Or do you see the dollar maybe coming back down for a little while?
I don't necessarily see it coming back down for a while, but I do, let's take the dollar back to gold and silver. One of the things that we've seen today is very high, a big increase in gold prices and silver prices. But if you take a step back, stock markets have been up, other currencies have been up, and it's really the dollar that has come off. And in that kind of environment, you're seeing a wide range of commodities and equities rise in value. So you have to be careful and not get too excited about the increase. I happen to agree with you that the price, has been forming a base, and I think we had 1720 as our short-term objective for gold over the last couple of weeks. But looking at the dollar, I can see it coming off a little bit on a short-term basis. But if you look at it and you say, why is the dollar strong? The dollar and the U.S. economy, for all of our warts and problems, we're in better shape comparative to Japan, Europe, the UK, China, Russia, other major economic entities. And I think what you're seeing is a tremendous amount of economic, political, and financial market insecurity. Last week the Fed came out with its bank stability report. And if you read it, you have to understand that they're not going to wave their arms around like some crazy on the internet. But if you read the statement, they say, there are a number of banks that are probably not quite well positioned to weather the next financial storm. And coming from the Fed, that means uh-oh. Yeah. So I think that if you look at the state of the world, there's a tremendous amount of problems, and there's a tremendous amount of uncertainty, increased volatility across financial assets, including gold and silver. And in that kind of environment, it's natural for a lot of investors to move to the dollar and to U.S. Treasuries because they're seen as the least risky place to park your money during a financial storm.
Yeah, I want to remind our viewers that, Jeffrey, I think you've got approximately 50 years of active commodity research background. And it's that long-term expertise and data that you pour into your work and your research that is in our reports that we have the great benefit of being involved with you on. And remind our viewers that when you call Monex, talk to an account representative and get this report, Precious Metals for More Than Just Inflation, you're getting a wealth of information and knowledge. Thank you for your time today, Jeffrey.